Welcome everybody to 15 Minutes of Finance, where in the next 15 minutes, I'm going to get you excited about investing. Let's do it. All right, we have news today. Earlier this week, we talked about PCE numbers. Today, we got those. Really good news. Driving stocks up, driving the market up. And today, we're going to talk about taking profits. Okay, we're going to talk about when do we take profits for clients? What is even the right mindset or frame of mind to have with this, right? It's so subjective and so unclear about institutionally and money managers. What do they do with their clients' money? Well, today I'm going to give you a behind the curtains look at what we do and what you should do. Okay, what you should do is way more important than what we're doing because you are your own unique person. You're an individual and you have your own goals. Okay, but we're gonna go over like the four metrics that the professional money managers use with either their institutional money, client money, or their own money. Okay, and part of that is going to be an investment policy statement, an IPS. Okay, don't forget this IPS. That is our term of the day here. So I'm going to read this for you. Commit this to memory. And if you manage your own money or you have somebody else who manages your money, okay, usually these cost something. They're fee dependent. But if you ask your financial advisor for an IPS and he's like, what is that? Or I don't know what that is. I don't know how to do one of those. You need to find a new advisor. Okay, this is critical because it sets out the guidelines, rules, and expectations. And when you follow those, you are almost assuredly way more likely to take profit or to be successful, be profitable. Okay, it's just like going into a basketball game, like an actual college level, professional level basketball game, and just being like, just go out there and try to score some buckets. Just go hoop. Okay, no, it doesn't work that way. When you're at that high level, just like with your own money, that's high level stuff, right? You don't want to lose. You need a game plan, and that's what the IPS is. Okay, so an investment policy statement, IPS, is a formal written document that serves as a strategic roadmap for managing an investment portfolio, whether for an individual or an institution. It outlines an investor's financial objectives, risk tolerance, time horizon, and liquidity requirements, providing clear guidelines and rules for the investment manager to follow. Okay, whenever I manage endowment funds, 529, nonprofit funds, large money, right? We're talking 10 million plus. I mean, these can get into the billions, trillions of dollars, but we don't manage that, right? Nobody I even know does that high level of stuff in the billions of endowment funds. But in the low 7 figures, you have to have an IPS. You have to have an IPS anytime you're managing institutional money where there are guidelines and expectations that you have to follow, right? And if individuals would have these for their accounts, they would make way more money because they would know that their emotions don't dictate their decisions, okay? The investment policy statement does. Okay, so we're going to talk about that later, but right now let's jump into the news. Look, pretty good week. We had all-time highs earlier in the week. And what are we at right now? Let me look at this real quick. Right now, S&P is at 66.44 spot 90. What's up? 60 bips from yesterday's close, which is good. Look, I'm sure we'll end up even higher here in the next hour or so. But let's get into this news so we can talk about when to take profits. That's a huge and very misleading topic that nobody ever really wants to talk about. So, okay, today in markets, let's read this. Stocks rose Friday after an important U.S. inflation reading matched expectations as major indexes look to snap a 3-session losing streak. The blue chip Dow Jones Industrial Average, benchmark S&P 500, tech-heavy NASDAQ advanced 0.8, 0.6, and 0.4 respectively. All 3 indexes had posted 3 straight record high closes through Monday before the current skid. The personal consumption expenditures inflation report indicated prices rose 2.7% over the year in August, up from 2.6% annual increase in July. The results matched expectations of economists surveyed by Dow Jones Newswires and the Wall Street Journal, making the 4th month in a row that key inflation measure has accelerated. Core inflation rose 2.9% year over year in August, also matching expectations. The 10-year Treasury yield, which affects borrowing costs on a variety of consumer and commercial loans, ticked higher to 4.19. The U.S. dollar index, which tracks the value of the greenback against a basket of foreign currencies, hit its lowest level since early 2022, about down 4.4% to 98.19. West Texas Intermediate Futures, the U.S. crude oil benchmark, rose 0.8% to $65.50 per barrel. Gold futures advanced 1% to 3,805. Bitcoin advanced 0.6 to just above 110. You know we love our crypto. You know we love our gold. Shares of furniture firm RH fell about 3%, and those of home goods retailer Williams-Sonoma, ticker WSM, pulled back 1% after President Trump announced new tariffs. Shares of Peterbilt parent PACCAR, ticker PCAR, surged roughly 5% after Trump said he's imposed a 25% duty on imported heavy trucks. Intel, ticker INTC stock, which paced the S&P 500 and NASDAQ yesterday by soaring nearly 9% for their third straight session of gains, jumped a further 6% to again lead the S&P 500. Shares of the chipmaker have risen more than 20% since Monday's close, aided by a report that the chipmaker has discussed Apple buying a stake. Look, I do got to talk about Intel here. Well, yeah, let me talk about it. So I bought Intel months ago, like April, maybe even earlier than that. And it was at $32 a share. And then it went all the way down to 15 or 19, I think. And I had to make a decision because I bought it for clients. It was mostly younger clients. I didn't sell any of them. I just said, you know what? Intel is going to get bought out or their business model is going to change. This is a great example of why you need to really do your research. The fundamentals in that company did not necessarily tell the story that the qualitative data did. Meaning the news coming out about their CEO, about the hiring and firings that they were doing, all of that stuff, if I would have known that whenever I initiate, I didn't put a lot. Maybe I put like 50 grand between 10 clients into this stock. So like $5,000 a client. It wasn't that much, but the decision to do it, I was a little bit motivated by the AI bump, right? In my head, I'm like, oh, I know Intel's fundamentals are, I know what they are. Everything about the numbers on paper looked good for me for an opportunity to ride the rising tide, right? If you guys know the saying, like, a rising tide lifts all ships. Within the AI chip making space, that's technically been true. So that was the thought process with Intel. Now that I've held it, there's no way we're getting rid of it because Intel is such a name brand that Apple, the government, NVIDIA, AMD, all these other companies are considering some sort of relationship with them. In what format, in what capacity, I have no idea, right? NVIDIA and AMD are competitors, so that's neither here or there technically right now, but the ramblings, right? The ramblings. Okay, I just wanted to mention them because they're up a significant amount, but even though they're a stock that I've picked, I still haven't, I don't even know what they're at. Let me look at what they're at real quick. Intel. They are 35.68. So we've officially made money, which is, great, right? We all want to make money, but this would be a good time now. Do I take profits? Do I take them out? Do I take clients out? There's a whole bunch of considerations. So let's jump into the main topic today, which is when do you take profits? You've probably made a bunch of money this year. How do you know when to do it? And there's really four main methods that people like me, institutional money managers, professional money managers use. And the way my firm does it is very client specific. So a lot of firms, one, they outsource their investment management, which I think is ridiculous. All that makes them is middlemen and salesmen, but that's neither here nor there. I've said that twice now. The big four with taking profits is you either have a calendar driven, like every quarter you're going to do rebalancing, every year or every month you're going to rebalance, which when you invest in something, you say 10% of my portfolio is going to go into these 10 stocks, right? And you say once it hits 15% of that position, I'm going to sell, right? Or if it goes down to 7% of my portfolio, I'm going to sell, right? And you sort of create these bandwidths. That's like event. Well, no, that's actually event driven. Calendar driven is just like every quarter we're rebalancing back to our initial position, right? And then event driven is once there's an event that a position either goes below a certain number or above a certain number. And that's when you make those changes at that event. Okay, so those are the two most common ways, I would say. And then the one that I now am having to really decide on and struggle with clients is this opportunistic method. So we'll use Palantir as an example. Some of our clients are up 900%. Like how do I not in good conscience take profits for these people? Okay. I have a client who put $40,000 into Palantir at $21. Okay. So think about how many times that's folded in half. We should probably take some profits. All right. But that client, they're in a brokerage account. And now I have to consider the tax, a taxable event. Like, oh man, do I think this is going to keep going up? Should we take profits? Should we play with house money? Right? That's another big one. That's opportunistic in theory, is that you just, anytime you feel like so Palantir, if it doubles, right, it goes to 80,000. Because we started at 40,000. So if it doubles, goes to 80,000, you just take 40,000 out and now you're playing with house money, right? You can do things like that. That's a decent idea. I think with companies like Palantir that are phenomenal and the outlook is, the ceiling is, you can't even see the ceiling. Okay. It's a glass ceiling because they're just going to keep shooting and breaking through it. I think there's a conversation to be had for not having opportunistic profit taking. You really focus on event driven, right? When Palantir reaches so much threshold of your portfolio, you sell. I think when you can do that, you will have, with great companies like Palantir, you will make the most of their volatility. Okay, so we have calendar, event, and opportunistic. Those are the big three that I would really focus on. And then the fourth one is what everyone does anyway. It's impossible to not do this, and I just call it the Free Willy method, because everybody has emotions. So for example, I have a client, and if he's watching this, I am glad you're a client, but you are also extremely emotional. And I want you guys to do your very best to not be like this gentleman. So there's a reason he has me, and it's because he's emotional. So he will call me and text me and be like, man, should we take profits on some of these? And some of his positions, it'll be like $1,000 profit. And I'm like, what? It's in an IRA. Why are we taking any profits? You're in great companies. Like, what are you talking about? And I know that he's been burned in the past by making trades. And yet here he is still wanting to make these like very ineffective quick trades. I have to remind him to come back to our investment policy statement. Okay, do not be free willy, nilly-willy with your trades. Okay, unless you're like an experienced chart tracking trader, you do not want to be trading quickly. All right, have rules with your market movements. When you have rules with your market movements, you will be more successful. Okay, anything that you do with emotions, like if I'll use again this gentleman, this client that I have, he wanted me to buy some hot stock yesterday, or maybe it was 2 days ago. I can't remember. I bought $3,000 of it, not very much at all. Drops 15%. Calls me today, texts me, hey, I don't want to be in that no more. Let's get out of that. And that is very exhibit A of why people don't make money. Okay, I had never heard of the stock. I didn't even want to do any research. I just said, if that's what you want, we'll do some of it. Okay, because I look at his portfolio and it's exactly how I want it. And it's been performing great. Above market returns, well diversified. He's got a long time horizon. His portfolio is probably going to double in the next 10 years. That's awesome. But he doesn't see it that way. And that's what I don't want you guys to have to be focused on, is what's happening right now emotionally with your positions. So have an investment policy statement. And just as a rule of thumb, I would tell you my favorite way to do profit taking is event driven. Okay, so it's an event that the position goes through, right? And we'll just use an equally weighted portfolio. So 10 positions, 10% in each one. Okay, once that hits 15%, I sell back to that 10. All right, and then you'll have a rebalancing period where you have all this cash that you took from your profits and you'll put it back in to the companies that were underweighted, right? Maybe they dropped to that 7% threshold and then you bring everybody back up to 10. And that has really shown, as long as you're in good companies and you're diversified, right? And their covariance is low. They have I'm throwing words at you guys. Sorry. Covariance is not a retail investor word, but it's technically beta, but just their relationship to each other is not very high. Okay. Meaning like if Palantir moves up 10%, maybe this other stock goes up 1%, or maybe it goes down 2%. You don't want things that are highly correlated because it makes it extremely emotional when there's highs and lows. And really what you want is something in the middle. Okay, that'll help for your emotions and how you'll be able to invest. Anyways, that is what I would do with profit taking. Okay, and if you guys are thinking about taking profits and you have something like Palantir that you've 2, 3, 500, 10 or a 10 bagger, if you have something like that, my encouragement to you, take some profits. Okay, shave a little off the top. It's okay. All right. There's always going to be a time to invest. Okay, so if you have cash ready to invest, which you only get from either putting more money in there from your job, from your income, dividends, or from taking profits. All right, those are really the only three ways. So when you're able to do that and you can jump in with profit taking during bad times or into new stocks that you really love, that's when you really start to see like, oh my God, my portfolio's made 50 grand today. Like, how did that happen? And that takes time, consistency, and sticking to your investment policy statement. Okay, guys, that is it for today. Hope you learned something. As always, invest early, invest often. We'll see you next week.